Let's ask Anastasia Amoroso, iCapital's chief investment strategist, here with me at Post 9. Welcome back.
Good to see you, Scott.
That is the central question after that unbelievable week we just had. Does that mean our chances of a year-end rally have now improved?
I think they have. I think they're back on. And you look, over the last couple of weeks or couple of months, I should say, we had a lot to worry about. And specifically, we're worried about what the Fed is going to do about the upward move in rates across the curve. We're worried about the Treasury and what the borrowing estimates are going to be and just how much coupon issuance we're going to have. But we put a lot of those worries to rest last week. And when I come into this week, what I think the slate is now clear for is seasonality. And seasonality is the strongest in November. It's the strongest in December. And something like 75% of the time, stocks do rally in November, December. Now you say, well, what about the 30% that it doesn't happen? And what I'll say to that is, what is the catalyst today? And I think the catalyst today still is the economy that is not falling apart. And maybe there's a recession in the cards at some point in 2024, but it's not today.
All right. Marco Kolanovic, J.P. Morgan, right, puts a note out shortly before our show in which he says, quote, falling bond yields and dovish central bank meetings are being interpreted by equity markets as a positive in the near term. However, we believe that equities will soon revert back to an unattractive risk reward as the Fed is set to remain higher for longer. Valuations are rich. Earnings expectations remain too optimistic. Pricing power waning. Profit margins at risk. And a slowdown in top line growth is set to continue. Those are reasonably valid points. What's your response to that?
I think that is likely to be the story of 2024. I mean, I do actually, Scott, share now the concern that 2023 was a soft landing year and everything sort of worked out perfectly. But in 2024, if rates do remain at current levels, that I think Marco is right, it is going to be a lot harder for companies to, for example, to repay their debts, to pay the interest rate that's now 5.5%. It's going to be more difficult whether you have leverage loans, whether you have fixed rate debt that you need to refinance. And so as that plays out throughout 2024, that's likely to be the case. But what I want to do today is decouple the trading view versus what I want to position, how I want to position my portfolios for 2024. And so that's why today I still think, we bounce off from current levels still, given the seasonality, given the buybacks. But if we do get the bounce back, perhaps you use that to your advantage and you start positioning more conservatively for 24.
It's interesting how you break it down because I like the way you say that. It's, this was the soft landing. Right? People thought we'd be in a recession already because of the move from the Fed and how quickly and how much they raised interest rates. But we're going to pay the piper for all of that. It's just going to be pushed off further and further. So is that a get while the getting's good over the next couple of months and then all bets are off?
Yeah, I mean, our crystal ball is becoming murkier, and I do think it's maybe a story of the next couple of months. I mean, Scott, we looked at, again, it's the size of the debt piles that need to be refinanced in 2024, whether it's the government, whether it's the corporates, whether it's the banks, all of that is going to have to come to be refinanced. And so to me, in order to say we now have an all clear on stocks, that it's time to go all in, we have to have a Fed pivot. We have to have the Fed say that we are going to cut rates sometime in 2024 or we're going to potentially slow down quantitative easing. If you don't get that, then I think it is going to be harder and harder. And the risks of the recession, they've been pushed off, but they've not been canceled. And I would say the longer rates stay at these elevated levels, the more those risks build. That's just how things work.
Why does the Fed have to be so explicit in saying, all right, we're going to cut rates, if we already think that their next move is a cut? Why do they have to come out and say our next move is the next cut?
Well, that's the thing that's challenging for markets. They're not going to come out and say that.
Right.
That's what the markets want them to do. And if they did that, then that's when you would buy the dip. But they're not going to do that.
We assume right now the next move is a cut. Right,
well,
they're done hiking.
Yeah, but we also assumed that we're going to cut by 100 basis points in 2024 and that we had to reprice that assumption. But what I worry about, Scott, is that I think the markets are going to force the Fed's hand. And what I mean by that is we're likely going to see higher charge-offs, higher delinquencies, higher bankruptcies. And once there's enough evidence, so to speak, the markets are going to be lower, but the Fed finally is going to move on that. But again, that point is not today. That point is sometime most likely in 2024.